Smooth. Piece of cake. Done before. Everyone doesn't feel so guilty about hanging out here on a rainy, nasty Saturday.
Hobbies in common. You guys have a talking point now, so
Great.
welcome.
Thanks. I don't need a mic or anything. It's good to be back. This is a nice, small, intimate crowd. So if y'all at any point want to stop me or chat about anything, just raise your hand or shout. It's good and there's bad news. The name of this speech is the Trinity portfolio. That is not what I'm talking about today. As I was writing the speech, I decided it was really wonderful for print, but incredibly boring for a speech. So we're not going to talk about that. But the good news is that'll come out as a research piece in the next month or two. So what we are going to talk about, which is more fun, is roughly 4 or 5 ideas. So thinking about concepts or systems. But first, if you don't know who we are, again, money manager. We've been around. We manage 7 public ETFs, soon to be 8. We're launching a digital investment advisory for individual accounts sometime this quarter. Hopefully, it's supposed to be last quarter, but you know the goal is offer a lot of hedge fund-like strategies for low cost. So to disrupt the traditional, very high hedge fund type of fee world. A lot of content up here. Over 1,500 articles now on my blog to keep you put you to sleep at night. Cambria Fund's website, plenty of research there. We have a research offering called the Idea Farm, and then more and more you can watch us pick fights on Twitter. For taking the time out on this rainy Saturday, you want a free book, go to that website, I'll send you one, freebook.mebfaber.com. We've now just published our 5th, which was Invest with the House, and the 3 in the middle are a lot shorter and quicker reads, but I think they're all interesting. So today, what are we going to talk about? We've got 30 minutes plus questions-ish. Let's review what I said last year if you weren't here. How we did, whether the ideas were terrible or brilliant. Talk a little bit about asset allocation, our newest paper, which is called Finding Yield in a 2% World, and then Omaha. And if we have time, there'll be one more bonus idea as well. So last year we talked about global stock market valuations, how to value global markets, what markets were attractive, does it work over time, and it turns out we think it makes a lot of sense to use valuation, and so we talked about using a 10-year PE ratio. Many people call it the Shiller-Cape ratio, and right now this is the way the world looks. The U.S. is around a value of 24, 25, which historically is expensive. It's not terrible, but it says usually future returns are going to be around 4% a year going forward. It's allowed to be a little more expensive when inflation is tame, like it is right now in that 1 to 4% safe zone. So not bad, but it, according to our rankings, the second most expensive country in the world. So that's the good news. The bad news is the U.S. expensive. The good news is most of the rest of the world is reasonable. These are equal weighted averages of 45 countries. So developed, the Cape is around 17, emerging around 15. But if you look at the cheapest bucket, the cheapest 25%, we're trading at around a Cape ratio of around 10. And that historically is very, very low. And if you break it out by quartile, you know, we often say in using valuation, people, when you start talking about Cape, their brain kind of short wires for some reason. I don't know why, but it elicits a very emotional response. We often say it doesn't matter. You can use anything else. You could use dividends, cash flow, price to book, and in general, they end up sorting on the same way. If you got a cheap country like Russia or Brazil, it's not going to have, almost always, it's not going to have any indicators that say that it's expensive. So for example, you know, again, the cheapest countries in the world around 10, big fat dividend yield around 5%, price to book around 1. And if you look at the most expensive bucket, it's double or triple that. So Cape around 23, price to book up around 3, which is where the U.S. is right now. Not great places to be. So if we go back a year, so April from the speech last year, I said, here's what these cheap countries look like, here's the ranking, and it turns out they would have, buying the cheapest would have performed great, at least on a relative basis. Still would have lost you money. So on an absolute basis, you lost about 8%. But compared to foreign developed and foreign emerging, they would have been down 12 and either 16 or 18. So it did better, still lost money, but we think they're particularly well positioned. And hopefully, if the first quarter continues, you know, we've seen explosive returns in a lot of those markets, particularly Russia and Brazil. We think there can be many years of that. And so we saw actually some wonderful confirming research from a group that we're very friendly with, Research Affiliates in PIMCO, published a lot about CAPE, but they said, what happens when things get to extremes, when there's serious blood in the markets? And they said, when a country goes to a Shiller-CAPE ratio below 10, what's the next 5-year performance? And it turns out it's roughly 17% a year. So really strong returns. We've actually did this in our book where we said actually below 7, and the returns were 20% a year. So very confirming evidence. And you can see, yeah, there are some cases where you didn't make any money, but on average, 120% over the next 5 years. Pretty good opportunity. I think there's 4 countries right now below 10, but in that 10 to 12 range, there's about another 10 countries. So a lot of countries in the cheap bucket. And really important with the value strategy like this is you should not update it much. Once a year is plenty. Once every 2 years is fine. It needs time to work. Again, other valuation metrics, it really doesn't matter what. This is Ned Davis chart, median price to sales ratio of the S&P 500. And as you can see over time, generational buying opportunity in the late 70s, early 80s, got up to being quite expensive, really cheap again in 08, 09, and then now it's the highest value it's ever been, up around 2, which historically is a pretty poor opportunity set. And then we often say you don't even have to use valuation at all. You can use other confirming indicators. This is how much people have in stocks, household equity percentage, and then it just flips it on the other side and 10-year future returns US stocks. Pretty damn high correlation coefficient. People have a lot in stocks, or the most certainly since, what is that, 07, 2000, and the early mid-60s. And this independent valuation said stocks should do about 3 to 4% a year, which is a pretty cool chart. Anyway, so we would say the exact same thing we said last year about valuations as we would say right now, which is most of the world is really cheap, and move away from the US. All right, so let's talk about where we're going today. I'm going to start burning through this pretty fast, so stop me if you want. So as you think about building a portfolio, and this is sort of the beginning of this Trinity portfolio concept, is that, let's look at history. And so historically, stocks, Jeremy Siegel would love a chart like this. This is real returns. It's U.S. stocks back to when the Fed got started in the early 20th century. Also comparing it to the U.S. dollar, meaning just there has been some inflation over time. And then T-bills and bonds. And a couple takeaways before we move on. And one is that for the most part of this century, T-bills and bonds had the same return. Not a huge bond premium for going out to 10 years, but really only with the interest rate market decline from the late 70s to now did you have the separation in bond and bill yields. Second is that U.S. stocks dominated everything else, so why not just put everything in stocks? And that's a reasonable conclusion. And then lastly, you probably don't want to put your money under the mattress because you're going to lose about 3% a year. But no one really does that, except my grandfather. He used to do that in Nebraska. But not the best idea. So, and then drawdown. So, most people know stocks are risky. 80% plus drawdown in the 20s, multiple 50% drawdowns. But again, this is on a real basis, and this is something that I think a lot of people don't appreciate, is bonds are risky too. And bonds are risky for a different reason, and that's that usually erosion of inflation. So there's been multiple 50% drawdowns in bonds, so that's just as bad as stocks for the most part, except you have the big cliff in the 60s and 70s and early 80s when inflation was getting out of hand. So if you look at this chart, you can notice one thing is that typically stocks, much more of a price-based sharp declines, whereas bonds, it can happen slowly over time with inflation. So the basic portfolio, the one that you can always start with, 60-40. We often say, look, this is like the Bogle, he loves this. This is a great portfolio. You get the return somewhere between stocks and bonds, a little bit lower volatility than stocks, nice and diversified. We say there's nothing wrong with this. This is a perfect starting point. However, there are lots of other assets around the world. And this chart of just a bunch of pictures, you could probably pick, I purposely didn't label this, but you could pick out a few of the asset classes for sure. You got T-bills here. The red, of course, is gold. But we said, how can you put these portfolio together? This is what 90% of financial advisors, investors, spend all their time thinking about. How much should I have in U.S. stocks? What's the Fed doing? How's that going to affect bonds? Is now a good time for gold? Should I have 15 or 5% in real estate? So we said, okay, let's look back at the most famous investors over time. These guys collectively manage in the trillions. If you don't recognize them, Rob Arnott, Research Affiliates, Dave Swinson from Yale, Mark Faber, no relation, Swiss economist, Mohammed El-Arian, Harvard, PIMCO, now semi-retired. Of course, Uncle Warren Buffett, and then Ray Dalio, manager of the largest hedge fund in the world. They've all gone on record and say, we recommend this type of portfolio for an individual investor. We think this is reasonable. So in our book, Global Asset Allocation, we said, let's go back and look how these performed all the way back to 1972. Let's see what the differences are. Let's see if we can find the best portfolio or glean some sort of takeaways from this. And so we simplified it in this chart just to show you the demonstration: global stocks, global bonds, real assets. Real assets is commodities, REITs, and tips. But 60-40, all seasons is the Ray Dalio. It's kind of a, it was in the Tony Robbins book. It's based on the all-weather risk parity style. Permanent portfolio, famous portfolio from Harry Brown. And then this is the global market portfolio. This reflects all global assets. Then Meb Faber and Arian. And what you can see is, for the most part, while the numbers are hugely different, so, Meb Faber has got half in real assets, whereas others may have as low as 15, 60-40's got 0. They all have some stocks, some bonds, and some real assets. Almost no one doesn't have some of at least one, at least 10% looks like in everything, with the exception of Warren Buffett, which is 90% stocks, 10% bonds, but that's basically stocks. So, all right, how'd they do? So you go back and look at the real performance for the last 40 years. We used 5 portfolios here because it's fairly instructive of what they are. They took different paths to get where they're going, but there's some really interesting takeaways. One is that the 70s sucked for everyone, for the most part, except for maybe the permanent portfolio, because that's 25% in gold. But what did well here then did proceedingly poorly thereafter. And so if you look at, for example, if you're a normal human being and like to chase performance like most everyone does, or even an institution, you would say 1972, 1980, obviously this is the best portfolio. We should all invest a quarter in gold, bills, bonds, and stocks. 60-40 or any of these other guys would have gotten fired here, and if not here, then certainly by here. But what we found is that if you, we'll come back to this later, but if you invested based on the best allocation of the past 5 or 10 years and rolled that forward each 5 or 10 years, that would have cost you about 1.5% a year. So chasing performance, of course, one of the worst things to do, because what worked in the 70s wasn't necessarily what worked in the 80s, 90s. However, over the entire period, the red dots are the assets, the blue are the portfolios, there was incredibly tight coupling. Of all the portfolios in the book, there was a 1% difference in final return, with the exception of permanent portfolio, because it was much cheaper. So all this work, all these differences in portfolios, 100 basis points difference. And that is a stunning conclusion to me. And the money chart, the thing we thought the most about is we said, okay, let's go back to 1972. You have a crystal ball, you get to pick the absolute best performing portfolio. Now we're gonna layer on the fees of the average mutual fund, 1.25%. That takes the best performing, the absolute perfect foresight portfolio and turns it into almost as bad as the worst permanent portfolio. You then layer on the traditional financial advisor, or just buy an expensive hedge fund or mutual fund, 2.25% total fees. It takes the best performing allocation and makes it far worse than the worst. Now, this is a boring takeaway for people because it's about fees and it's about blocking and tackling. It's about the basics. It's not as much fun as saying, how much am I going to put in gold? Is it a good time to buy stocks? Should we be buying China right now? But this boring stuff is what probably has the most impact on people's returns. And there's, of course, some other dumb stuff that people do that on the pyramid of importance are far more important than your actual allocation. This is a chart from a RIA based in LA, but there's a number of academic studies. Dalbar is probably a little exaggerated, but Morningstar tracks this as well. And this is basically what the cost of investors chasing returns is. And my favorite is looking at the time-weighted versus dollar-weighted returns in Morningstar's database. The best example ever is the mutual fund manager of the decade, Ken Hebner's fund, in the 2000s by Morningstar did something like 14% a year. The average invested dollar in that fund not only didn't do 14% or 10%, it had negative returns because he had a 70% up year, all the money comes in, and then he loses 70% after that, right? So on the scale of things that are important, this is probably up there with fees as not doing dumb stuff. And there's a lot of condescension from the professional community, and I include myself there, about chasing performance and all the dumb things that retail individual investors do. Well, this is a white paper about institutions, and it took a look at 8,700 hiring decisions by 3,400 plan sponsors, over 630 billion in assets, and it's looking at the managers when they made a manager change. So there's the manager coming in, the manager going out. And what they found, here's the excess return of the manager coming in. So this is the hire date. So the 3 years prior, excess return of the manager coming in versus the one coming out, hugely positive. Obviously, why else would you fire someone and hire someone else if they were doing better? So a better performer coming in, and then of course after they fire them, what happens? It's the exact opposite. So these institutions are just as guilty as anyone else. So of the asset allocation, in the importance, fees and not doing dumb stuff, sticking with the allocation, vastly more important than your actual allocation. As long as you have some stocks, some bonds, and some real assets, it really doesn't matter that much. Now, if you're capable of doing all of those things, if you're capable of a rules-based approach, and if you're capable of avoiding fees and chasing performance, there's then a few other things you can do, which is the point of this Trinity talk that we'll publish soon. And those two things in my mind are tilts within the portfolio. So if you have an equity exposure, call it smart beta, call it moving away from market cap, whatever you want, towards value and momentum or other traditional tilts. Patrick may talk about this next. And then also, my favorite, my desert island portfolio is adding some form of trend. Now, whether that's trend as an overlay or trend as an allocation, so through managed futures or a momentum type of fund, that of all the assets is likely the best diversifier to a traditional portfolio of stocks, bonds, and real assets, because it usually protects in either a highly inflationary environment or deflationary environment when everything else is going down. So if you look at managed futures in '08, outstanding performance, and then of course terrible from the 4 years after, had a good year last year as a lot of commodities declined. Okay, moving on. As you think about a traditional portfolio, we always say the starting point is the market portfolio. What is the world group of market cap assets based on? That's the starting point. Anything that departs from that is active management. So that is the index. Jack Bogle would highly disagree with me here, but that is the starting point. Anything else you do from that. And so we talked last year, and every time I've given that global value speech, without in a single exception out of 20 times, we asked the audience, how much do you have in foreign stocks of your global allocation, or how much do you have in the US? And the answer is almost always 70%. And the market cap of stocks as a percentage of the world is half. So if you were going to put any more than half in US stocks, that's an active bet. The same thing applies to foreign bonds. Foreign bonds, many people are surprised, is the largest asset class in the world. So you have US bonds, developed ex-US, emerging market, which is the smallest of the three, but ex-US bonds, not surprisingly, is the largest asset class in the world. You ask a traditional advisor or an individual how much they have in foreign bonds, it is almost always zero. They may have a sliver, 2%, 5% maybe, in emerging markets or some other foreign bonds, and they can list a laundry list of reasons why they would never buy foreign bonds. Doesn't make a whole lot of sense. So let's look at the global landscape, and here's usually the first reason. For the same reason you shouldn't invest in global stocks based on market cap, which means you have half in the US and it's the most expensive market in the world, investing in bonds by market cap, the equivalent is simply how much debt do they have out there. So 70% of the world's debt's 5 countries, US, Japan, UK, France, Germany, 70% of the world debt. You know what that basket yields? 50 basis points, half of 1%. So it's no surprise no one wants it. A few of the countries are actually negative. And so if you look at the US, that looks relatively steep yield compared to the rest of the world, around 1.6. These are 10 years. Developed countries average is around 1.2. Emerging is much higher, 5.9 on average. This isn't market cap weighted, this is just average. And the world average is around 3.5. However, there is a lot of research that shows if you sort bonds based on simply nominal or real interest rates, you end up with better returns, a better portfolio. So if you look at the 45 countries in the world the same way you would look at global value on stocks, you end up with a portfolio that yields around 7.5%. Depends if you include Egypt or not. That's in some of the emerging market indexes. Some it's Frontier. It yields 15%, so that would add another 100 basis points of yield onto this. And the normal spread, depending, is around 1 to 6% above the world. So right now we're sitting at a 4% spread. That's on the high side. This is probably 85% in emerging markets right now, about 15 in developed. Whereas the stock version of global value is about is much heavier in developed world. But you know, this gets up to about 6% blowout spread when there's a lot of crisis. But what does that look like historically? Here's the equity curve. The blue is the top third of the world. Foreign and average. This is essentially market cap weighted, and then average of all countries very similar. Here's a chart that you're probably not going to be able to read, but it's a bunch of gibberish. But here's the 1950, the returns. It basically shows that by investing in the highest yielders, you add about 200 basis points of return over time per year over foreign or equal weight, which was also higher than US. You pick up a little bit of drawdown, but the nice thing, the correlation with even the traditional basket of bonds and US stocks and bonds is fairly low. So you end up with a nice diversifier. Now, there's a lot of reasons people will say why you would never invest in this. And so the first they say, okay, question I always get is, do you hedge the currencies? And for a sovereign portfolio of developed countries, I think the answer should be yes, because you're adding currency volatility to a portfolio that traditionally is low volatility. For a high yielding portfolio, I think the answer should probably be no, because for the most part, it's more volatile already, but it doesn't have, it gives you more of the diversification benefit to a traditional portfolio. And even during the 70s, you see, you know, rising interest rates big time in the US. In this environment, this portfolio actually did much better than US bonds and in line with equal weight and foreign as well. Any questions so far? I'm flying through this. Good. And we just happened to have launched a fund based on this about a month ago that invests in all these countries. All right, so 2 more ideas, and then we're going to slowly wrap this down and have a little Q&A. Another idea as you think about investing, and this is probably great for the Quantopian crowd because you can access the data all online for free, is the topic of our most recent book is if you are an investment manager with over 100 million in assets, you have to report your assets once a quarter. And it's called the 13F filing. So most of you are probably familiar with this. And way back, we used to print these out in the year 2000 and look at what a lot of these managers were buying and selling. And it was always a curiosity to me saying, could this be of value? Is this something that you could piggyback on Warren Buffett? And in being a quant, I said, I can never get comfortable with this until we test it. And so about 2005, 2006, grabbed a poor intern, went and tested about 10 of these managers by hand, so downloaded all of these historical filings. And so the way they work is they come out each quarter, and then it's 45 days delayed after the end of the quarter. So you get a filing for Warren Buffett, for example. His holdings for the end of the year comes out March, wait, is that right? Hold on. What would be the 45? February? I can't even, it's too early on a Saturday, 2 p.m. for me. Anyway, 45 days after the end of the quarter, February 15th, you'll get the return, you'll get the holdings from the end of the year. And so we said, all right, let's go look at Warren Buffett first. So we'll go back to 2000. We'll look at the portfolio, obviously adjusted for all corporate actions, delistings, non-survivor bias. What would happen if we just bought his top 10 holdings, the 45 days delayed, so including that, plus another 5 days just to make sure that the portfolio could be formed, and then rebalanced it once a quarter? Is it possible to piggyback on Buffett? Well, it turns out, this is from a website called Alpha Clone, but it turns out that it actually works great. So you could piggyback on Buffett, and going back to 2000, would have outperformed the market by about 5-6% a year. It's a monster number. There's now been academic papers that have come out that show that you could actually get non-digital versions of 13Fs going back forever. The SEC reading room in DC. It's a business opportunity for someone to go digitize all those, or copy them by hand, but I don't want to do it. So, and a lot of those managers aren't managing money anymore anyway. But so you have it back to 2000 digitally, Buffett, there's papers that take it back to the 70s, I believe maybe in the 60s, and say, hey, how would this have done as well? And it turns out he crushes it over the whole period. And people always say, well, you can't, why not just, you can't follow these guys. And sure enough, now, this track record going back to 2000 would have beat 98% of mutual funds in the United States. So why would anyone do this? It's free and it's tax efficient. And here's the exact reason why investing is so hard for people, and the exact reason why a lot of people will never do this. It's because if you look at the returns, you probably can't see it up here, but this is returns of Buffett versus the S&P and the outperformance. He's underperformed the broad S&P in 7 of the last 9 years. And that's because value has been kind of stinking up the joint for a lot of those in general. Despite the fact he's underperformed 7 of the last 9 years, he's beaten the market over the last 15 years by 6% a year. So how many people would be willing to invest in a manager that's starting in, whatever this was, 2006, underperformed that many years, and now it's 1, 2, 3, depends on this year, 4 or 5 years in a row? Not many would. Many would have given up a long time ago. This manager would have gotten fired. But that's the challenge of an investing strategy. It's such a long time horizon for following a lot of these strategies, whether it's value, whether it's managed futures, whether it's stocks, bonds, anything, is being able to commit to something like this for a long time. The good news is a lot of these great managers have been getting pounded. My favorite of all time, Seth Klarman at Baupost, is in something like a 50% drawdown right now. So you can go buy this portfolio at essentially a huge equity curve loss, and piggyback on him. I saw a question, yeah.
I think there's a little selection bias there. Starting in 2000, he gets off to a big start. First, 3 years.
There's a famous quote from Julian Robertson of Tiger when one of the young managers asked him what's his best advice, and he says, get lucky and have great performance in the beginning, because then everyone will think you're a genius and tons of money, you'll raise tons of money. And I think there's a lot of truth to that. So, in the beginning of this book, we say 2 things. We say, for you to even think the strategy is possible, you need to believe 2 things. One is the market's not efficient, and 2, you can identify managers. And those are not trivial statements. Not only that, so when I started doing this by hand in 06, 07, I asked all my hedge fund buddies, I say, give me your 10 favorite hedge funds. If you had to allocate to these guys, you have to give your own money to these 10 funds, who would you give money to? And in mutual funds too, but in general, most the hedge fund world attracts the top talent. The best part of this, by the way, is avoiding the fees, 2 and 20. So you replicate many of these, some of these clones beat the underlying manager, which is kind of amazing. Shorts don't show up, derivatives don't show up, and you don't want a high transaction turnover manager because of the delay in the filings. But going back to the selection bias, so we used to look at it by hand in 2005, 2006, and almost everyone that we had asked would say, who's a good manager? On all the lists was Galleon. And for those in the audience who are familiar, Galleon turned out, and so we used to clone Galleon, and you can find this in our archives on the blog if you search it. It cloned terribly. We said, I don't understand why this hedge fund has such great performance. The clone is atrocious. He's terrible at picking stocks. Well, it turns out it's because he was insider trading around earnings announcements. And so the clone, it literally looks like this. And so we were like, that just doesn't make any sense. So the good news is if you allocate to a manager like that then gets in trouble, if you're an endowment and you're allocating to one of these guys, you may get locked up, you're gonna have a run on the portfolio, whereas if you're an individual and it's in your own account, you just sell it. So yes, there's obviously gonna be some selection bias. I think you can cobble together a group of 5 or 10 of these managers. One of the biggest takeaways in the book so there's a lot of people out there that track 13Fs. A lot of people out there track 13Fs incorrectly, in my mind. They track a lot of managers where it makes no sense to track them. They may be talking about Renaissance or the old SAC, or all these guys that are doing arbitrage. It makes no sense to track a lot of these, certainly anyone using futures. And they also like to, for some reason, because they haven't spent enough time with the data, invest in the most popular holdings or the number 1 holding, the biggest. They just assume that's the best idea. The number 1 holding of the top 10 is the worst performer. Still beats the market, but you would much rather invest in holdings 2 through 5, and probably one of the reasons why is by the time it becomes the largest, it's likely because of appreciation rather than it being their best idea. And so the good news is you would have avoided in half these funds Valiant, because all these guys had it as their largest position and got hammered. But this is an area that's not pure quant. You have to have some domain expertise here to be able to say, oh, I know this fund, they're too big. Oh, I know this fund, he's going through a nasty divorce and is spending all the time in Vegas. You know, these are very real sort of, or you say, look, Valpost is a great organization. I realize that 75% of their book is not equities, but it's a worthwhile one to piggyback. And the good news is, if you haven't been doing this now, a lot of these managers have been getting killed for the past year and a half, 2 years, as small caps and mid caps have done much more have had poor performance relative to the S&P. Let's talk about the one bonus idea, and then we'll get to any questions if we have some, because I think we're running out of time. Any more questions on 13Fs while we're there? Wait till the end if they are. Man, this came out awful. I did this morning, so you can see that my lack of coffee is effect. It's a nice green, yellow color scheme. So we did a study on the blog that was pretty fun, and there's so many free data sources out there. I was trying to convince the Quantopian guys last night that they need to start incorporating some of these longer data sets that go back. And yes, it's at a lower frequency, but stuff like the French Fama database, which is free and has monthly returns going back to the 20s. Massive amount of really cool information. But something they have, for example, is they have sector and industry returns in the US. So sector, let's call it 10-ish sectors, industries, that's maybe 30 or 40, but going all the way back to the 20s. And so we had a curious idea, as we said, okay, we actually wrote about this in our book in 2007, the Ivy portfolio. We said, what happens to a sector or an asset class when it's down 2 or 3 years in a row? I think we did. And it turns out that the more years in a row it's down, the better the next year performance is, and that makes sense. You're just getting some mean reversion. I don't know why I stopped at 2 and 3 years, because there are some that have been down 4 and 5 in a row. It's very rare. But the reason I wrote about this, I did a blog post at the end of the year. It says why you want coal in your stocking, why you want to ask for coal, parentheses, stocks, in your stocking for Christmas. And the reason why is that if you go back to the 20s, and this is the number of years down, so the whole database all the way out to 4 or 5. And so first thing you'll realize if you are a good math student is you say, wait a minute, stocks didn't have 13, 14% returns over that time period. Those are average returns. So if you did then geometric, you're going to lop that down to probably 11, 10% with those little volatility equivalents. So you could probably take 3% off all these just to give it a perspective. But what happens, and after 2 down years in a row, 3 down years in a row, 4 or 5, what happens in next year performance? Well, it turns out as you get to 2, starts to kink around 3 down years in a row, you get some pretty interesting returns. Now it gets pretty rare. Down 3 years in a row, 3% of the time. That's a pretty rare takeaway. Down 4 years in a row, 1% of the time. Down 5 years in a row, 0.2% of the time. It's only happened a few times. And there's only been a number of sectors and industries last year were down 5 years in a row. Excuse me, coal, gold miners, metals and mining in general, the yen, were all down 5 years in a row, I believe. But the problem with this is those that are all down 5 years in a row were also at one point down 3 years in a row, then 4 in a row, and they just kept going down, right? So you may have been tempted around here and said, look, 25% average returns down 3 in a row, and then they go down 50%. So it's an interesting strategy. It could be used with options. It could be used with small position sizing. You could wait till it goes above its long-term trend. There's only been, but as I did this post, I said, look, 40 to 60% average return 1 year forward, down 5 in a row. That's awesome. Caveat, there has been an instance where a sector or an industry has been down 6 years in a row. Only once, ever. And guess who it was? It was also coal during the Great Depression. So these are the 20s to the 50s. And so you had this period where it went down 6 years in a row. You can't see because this is a log chart, but that's pretty massive returns. And then again, got crushed again in the kind of echo of the Depression. So, but how these do so far this year, these assets are just on fire. Coal, or gold miners, metals and mining, coal, yen. So we've done a number of studies in this similar vein, one of which was looking at sectors and industries when they're down 60, 70, 80, 90%, and the same takeaway. And the one area for future research, so we have the enterprising analysts in the audience that want to go look at some of this, you can online and report back. I'll update it on the blog. But going back to that old research affiliates PIMCO post, there's no reason to really stop at 1 year here. as just, it was a simplicity for me of doing it instead of probably out of laziness. But in reality, something that's down 60 to 90%, as well as 5 years in a row, probably has 3 to 5 years of outperformance coming up. So I haven't tested that, but it's probably a great idea. Would be a cool idea for a fund or a diversifier, and you get the added benefit of owning stuff that everyone else on the planet hates, and you can be quite the contrarian. So I'm going to wind this down. I stole this from someone, but it's my favorite ending to a speech. So do we have any short speeches? Questions? Anybody?
That 5 years down, 4 years down, that's on a calendar year basis
Yeah.
all the time. Yeah.
So there is a large amount of research somebody could probably do in that area that I think there would bear a lot of fruit. So there's a lot of ways to tackle it. So you could do looking for opportunities on a rolling basis. You could look at simply a percentage down. And what happens? So what happens is that we also did a post on the blog this week that compared global stock valuations against what their current real drawdown was. And not surprising, there's a high correlation where the countries that are most expensive are near all-time highs, and the countries that are down 60 to 90% are trading at low valuations, because as we said in the post, it's the P and the PE that's volatile. It's the price that moves. Not often, it's not the earnings that moves as much. So there's a high correlation probably between what's down 60, 80%, what's down 5 years in a row, and low valuations. It's not always the case, but usually there's a high correlation. So there's probably a ton of, if any academics in here want to write papers, this is 5 papers alone looking at mean reversion types of strategies that you could tie together based on coupling them maybe with trend following or coupling different types of ideas. And the cool thing is they're pretty rare when they do happen, but you can have some pretty explosive moves. So I think there's a lot of opportunity there. So if you do any research, email me.
How can you take into account that the overall correlation between the U.S. and the emerging and developing markets are increasing in the last 5-10 years?
So there's a couple comments on that, and if you didn't hear, the questions on globalization, markets, correlations, we always assume equities, at their worst, are just going to be 100% correlated because they're all stocks. It's a global world. Do you have some benefits of being non-correlated? Probably. But when it hits the fan, you should never count on that in your assumptions. And that's the same thing with asset allocation in general. As you saw in 2008, that's why that surprised so many people, is because you hadn't seen that environment really since the 30s, where all the assets went down with the exception of bonds. It's kind of a deflationary decline. And it surprised a lot of people, endowments included, that then lost 50%, or drawdown at least. And so we don't assume any diversification benefit. And one of the comments almost always when we talk about the home country bias of investing too much in the U.S., they say, no, Meb, U.S. gets a third of its sales from abroad, so it should be higher because you get a foreign exposure already. And the rebuttal to that, of course, is you don't think the rest of the world has exposure to U.S. sales? Like, of course, it's the #1 economy in the world. They get most of their sales from the U.S. in many cases. So it's a very intertwined world. And if you come to that conclusion, so yes, there is a benefit to foreign diversification, but if the world is very intertwined, there's even more reason not to have home country bias and look for value anywhere it may exist. There's a lot of different ways to do that. You could do it bottom up, you could do it top down like we do, but really to now overweight the expensive stuff. And this is a key takeaway I always forget to mention. When you're doing value or something like that type of strategy, it's not just that you're investing in the cheapest stuff, but you're also avoiding the most expensive. And that's a hugely important concept, because if you look back at global valuations, even over the past decade, China, India trading in the 40s and 60s in 2007 when everyone wanted the BRICS. US in the late 90s are trading at a value of 45. And the biggest one of all, Japan, in the late 80s hit a value of almost 100. So it's not just that you were buying the cheap ones, it's also that you were avoiding the really expensive stuff too. If you get a correlation benefit, that's even better. We look for a lot of non-correlation in other places. I think people are certainly underallocated to some assets such as managed futures and gold. But that's a much better diversifier than say, globalization. You got another one? Go ahead.
So you build these portfolios mostly rebalancing in some very specific period, but keeping the people mandate percentage and dividend exposure fixed, right?
So
How can you? So there are various.
So interestingly enough, and this is an interesting takeaway a lot of people don't think about, is that if you were a global market cap investor, you never rebalance. So you think about that. So as a market cap investor, you don't have to ever rebalance. It will simply continue to reflect the global portfolio, because that's what the global portfolio is. It's weighted on how big it is. But market cap weighting is not the best way to invest, because it invests in stuff that typically gets more expensive. And so rebalancing is seen as a wonderful thing to do. We showed in our first book, it matters as long as you do it sometime. That could be every 5 years, it could be every year. Traditionally, if you're a taxable investor, it makes sense to do it with an eye on taxes. You can do tax harvesting and put assets in tax shielded accounts, but it really doesn't matter, and people rebalance way too much. With the global value stuff, 1 year, 2 year, every 3 years. With a momentum or obviously a very active strategy, monthly or quarterly is much more appropriate, but that's because you're being much more tactical. So a lot of this stuff, the less you do is probably even better. It's hard, of course, but to watch. But we have time for one more.
When you were analyzing the all-weather portfolio, did you use leverage at all to? Because I mean, it's
We
a lot of
haven't.
volatility in
The
portfolio.
question is asking about risk parity and all weather, which is kind of one of the cornerstones of a risk parity approach. Is you have a level playing field of assets based on their volatility. And the simple takeaway is you often end up with more in bonds or low vol investments, so then you can leverage the whole portfolio. Usually it's around 130, 150% gross. And so we have a post on the blog called, I don't think it made it in the book, but it may have, I can't remember. It's called How to Clone the Largest Hedge Fund in the World. So all weather is basically just the global portfolio with leverage. So you can get the same returns as Bridgewater's all weather just by buying the global portfolio with a little bit of leverage. So 30%, I can't remember, 30%, 50%, you'll have to look it up. But that's of course different than pure alpha, which is the fund you really want. But yeah, the basic world portfolio, add a little leverage. I mean, risk parity, I'm pretty agnostic on the topic, but I think you just, for the most part, end up with a little more. It's done very poorly the last couple of years, so it's probably a good time to enter now. 30 seconds. Anyone else? I'll stick around for questions if you want after Patrick's. Thanks for having me.
So we have about, I believe, 20 or 30 minutes for our afternoon break. There's snacks down by the registration desk, so you guys are free to kind of roam about for the next couple minutes. Or ask questions.
Hey.
Thanks for favor.
What's up?